Okay, let's unpack this. Permanent life insurance. I mean, we're talking about those policies that mix lifelong protection with an investment component. They are incredible financial planning tools, but really only if you understand the strict tax guardrails they operate within. This isn't just about paying premiums, it's about navigating the Income Tax Act.
That's absolutely right. When we talk about permanent insurance, we're fundamentally talking about tax deferral. Sure, the final death benefit is generally tax-free, but the ability of the policy's cash value to grow tax-deferred while you're alive, that hinges entirely on compliance. The government is always asking, is this policy primarily for insurance, or is it just an investment disguised as one?
So our mission today is translating those complex concepts and the acronyms, and there are a lot of them, into practical knowledge for you. We're going to decode ACB, your adjusted cost basis, and MPR, the maximum tax actuarial reserve. And these aren't just technical terms. They're the numbers that determine if you wake up with a massive unexpected tax bill.
That ACB calculation is arguably the most important number in your policy. It's your tax cost measurement. It's the baseline that determines your gain whenever you dispose of or withdraw funds from or transfer the policy. If you don't know your ACD relative to your cash surrender value, your CSV, you are completely blind to the tax consequences of any transaction.
Okay, so let's start with a surprisingly common one that can immediately trigger a tax event: taking a policy loan. You think you're just borrowing your own money. But for tax purposes, the moment you take that loan, it's treated as a proceeds of disposition event.
And that's the core shock factor for a lot of people. The proceeds of disposition is basically the loan amount itself. There's a small adjustment. You subtract any part of that loan that was used to pay the policy's premiums, for example, an automatic premium loan, an APL.
Right.
The proceeds are nil because the money went right back into the policy, not into your pocket.
So how does this actually impact that crucial ACB? Let's use an example. Let's call our policyholder Alicia. Her policy has a healthy ACB of $10,000.
Okay. If Alicia takes a moderate loan, say $4,000, that's less than her $10,000 ACB. In this case, there is no taxable policy gain to report. The transaction is clean, tax-wise. She just has a debt to the insurer.
So her ACB just goes down.
Exactly. Her ACB is simply reduced by the loan amount, so it drops to $6,000. She's fine.
But the rules are really designed to penalize you if you try to pull out too much tax-deferred growth too soon. So here's the tax trigger. What if the loan exceeds the ACB? Alicia has that same $10,000 ACB, but she takes out a $19,000 loan.
That's where the pain comes in. She has instantly realized a taxable policy gain of $9,000. That's the $19,000 in proceeds minus her $10,000 ACB. She has to report that $9,000 as investment income right now.
Wow.
So if we assume she's in a 35% tax bracket, she owes $3,150 in tax. And worse, her policy's ACB is now wiped out. It's zero. She realized income without ever actually surrendering the policy.
That's a huge surprise. You've just borrowed money, and suddenly you have a tax bill. But there is some relief if you start repaying that loan, right?
Yes, the system does account for repayment, but, and this is a big but, only up to the policy gain you previously reported. So following Alicia's example, if she repays $12,000 of that loan, she can deduct the $9,000 policy gain she reported. It effectively reverses the taxable income.
So the key is that the tax deduction is capped at the previous gain. What happens to the other $3,000 she paid back?
That excess repayment is the only part that actually increases her ACB again. In her case, that extra $3,000 she repaid, that increases her ACB from zero back up to $3,000. It's slow, but it builds the tax cost basis back up.
Okay, moving on to policy loan interest. We often think loan interest is deductible, but the source material is very specific here. When can you actually write off that interest?
You can only deduct it if the loan proceeds are invested for the explicit purpose of earning property or business income.
So things like interest, dividends, rental income.
Exactly. But here's the critical part. Using the loan proceeds to earn capital gains does not qualify.
So if Alicia uses the loan to buy mutual funds or stocks, hoping for growth, the interest isn't deductible.
Correct. Or if she uses it for personal stuff, like buying a car, it's non-deductible. The one little upside of non-deductible interest, though, is that if she pays it, that interest expense actually increases the policy's ACB.
I see. So it's a quiet way to build up the policy's tax costs.
The very quiet way, yes.
The consequences of a big loan really show how dangerous that cash accumulation can be if you try to access it. And that brings us to the government's biggest concern: stopping policies from becoming overloaded investment vehicles. This is where the maximum tax actuarial reserve, or MTIR, comes in.
Here's where it gets really interesting. We need to distinguish between exempt and non-exempt policies. Exempt policies, and that's the goal of every permanent policy, they allow that investment growth to be tax deferred and potentially tax-free if it's paid out as a death benefit.
The danger, of course, is that non-exempt status. If you fail the government's exemption tests, your policy becomes subject to annual accrual taxation, which means you have to report the policy's internal investment income every single year.
Just like a GIC or a mutual fund in a non-registered account.
It totally defeats the purpose.
Exactly. And this is why the government created this whole framework, the MTR and the anti-dump-in rules. They're the gates that determine, is this a true insurance policy, or is it an investment fund using an insurance wrapper?
And the MPR is the main gatekeeper. It's a literal line in the sand of ceiling. Your actual cash value cannot go over this MTR line.
And that ceiling is defined by a theoretical benchmark policy. It's called the exempt test policy, or ETP.
Okay.
Your policy and the ETP have the same death benefit, same insured life. But the ETP has this fixed deposit schedule and assumed interest rates that are all defined by the Income Tax Act.
So it's like a government-approved model for how much cash you should have for that amount of insurance.
Precisely. It defines the maximum amount of cash the government thinks is necessary.
And the rules for that benchmark policy, they depend entirely on the generation of your policy. If you have a G3 policy, so post-2016.
For a G3 policy, the ETP is benchmarked as an 8-pay endowment at age 90.
Okay, an 8-pay, what does that mean?
It means the deposits are fixed for only 8 years, and they're aiming to equal the death benefit at age 90 based on a minimum 3.5% assumed interest rate. Now, you contrast that with the older G2 policies from 82 to 2016. For those, the ETP is a more generous 20-pay endowment at age 85, using a slightly higher 4% assumed interest rate.
So what you're really saying is that the G3 rules are fundamentally stricter. An 8-pay benchmark means the policy has way less room to accumulate tax-deferred cash than a 20-pay.
Exactly. G3 policies generally have a lower MTR line. They restrict the maximum permitted deposits much more aggressively. This really highlights why holding on to those older G2 policies is a huge advantage, and why the G1 policies pre-1982 are the gold standard. They're always exempt, not even subject to this test.
So what does this all mean if your policy accidentally hits that MTAR line? If a policy fails the exempt test, the source material says the loss of status is, well, it's brutal because it's permanent.
It is permanent, which is why most carriers have automatic processes built in. The insurer usually has a 60-day grace period after the policy anniversary to fix the issue before that exempt status is lost forever. If you lose it, every dollar of growth from then on is taxed annually.
Okay, so the insurance company has a few ways to fix this. The first remedy is pretty straightforward. Just increasing the face amount, the death benefit.
That's the easiest fix. Increasing the death benefit effectively raises the MTAR line, which gives the investment account more space to accumulate cash without breaching the ceiling. Many policies are set up to do this automatically.
The second remedy is withdrawing premiums, which pulls the cash value back below the MTAR line.
Yeah.
But didn't we just establish that a withdrawal can trigger a policy gain?
It absolutely can. This is the classic solution creates a new problem scenario. We have the example of James. He had to withdraw $10,000 from his universal life policy to keep it exempt. His policy had a cash surrender value of $400,000 and an ACB of $226,000.
Okay, so a $10,000 withdrawal. The tax office doesn't just look at that $10,000 as tax, do they? They look at the prorated part of the ACB.
Exactly right. Since the ACB was about 56.5% of the total CSV, the prorated ACB for that $10,000 withdrawal was only $5,650.
So James instantly realized a taxable policy gain of $4,350.
Yep. He fixes his policy's exempt status, only to realize he now has an unexpected tax bill on the withdrawal. It's not a great conversation to have.
Which makes the third remedy, the side fund, seem a lot more appealing.
The side fund, or shuttle account, is designed to avoid that exact problem. If the policy is getting close to the MTR line, the excess cash is automatically moved into a separate taxable side fund. This keeps the main policy exempt, and crucially, those funds can be shuttled back into the main investment account later if the cash value drops below the MTR line again.
Now we need to talk about the second big guardrail, one that often catches people planning for retirement. The 250% rule, also called the anti-dump-in rule.
This one is sneaky. It's specifically designed to stop policyholders from making huge, sudden cash deposits years into the policy.
And it only applies starting on the policy's 10th anniversary, right?
Correct. From that point on, the current investment account value is compared to the value 3 years prior. If the current value is 250% or more of that value from 3 years ago, you've triggered the rule.
Let's use Dean's example. On his policy's 7th anniversary, the cash value was, what, $4,200? 3 years later, on the 10th anniversary, he makes a big deposit, brings the value up to $15,600.
And that $15,600 is 371% of the $4,200 value. The rule is instantly triggered.
And the consequence is severe.
Very. The exempt test policy date gets reset to the 3rd preceding anniversary. This drastically lowers the MTR ceiling benchmark going forward and makes it much more likely the policy will permanently fail the exempt test.
What's most critical here is the warning about universal life policies that were minimum funded early on. That strategy sounds smart, but it sets you up for this trap, doesn't it?
Absolutely. A lot of people minimum fund their UL policies when they're young and plan to catch up later. But if they make a large catch-up deposit after that 7th anniversary, that low initial cash value makes it way too easy to blast past the 250% threshold.
Suddenly jeopardizing the policy's tax status just when you thought you were being responsible.
It's a major pitfall.
Okay, let's pivot away from those accumulation risks and look at ownership changes. Replacement and absolute assignment. Replacing a policy. It sounds easy, but the tax hit can be immediate and brutal.
The number one rule: you must put the new policy in place before canceling the old one. If you cancel the old policy first, it's a disposition. It will immediately trigger a taxable policy gain.
CSV minus ACB.
You got it. You could be facing a major tax bill before the new policy is even finalized.
And this just emphasizes the enormous tax advantage of holding on to those older policies, especially the G1 policies from before 1982.
Those G1 policies have two huge, irreplaceable advantages. First, they are permanently exempt from all MTAR hasting.
No ceiling.
No ceiling. And second, their original ACB calculation method, just cumulative premiums minus dividends, almost always resulted in a much higher ACB than modern policies. A higher ACB means a lower gain if you ever dispose of it. Replacing a G1 is almost always a mistake.
Okay, so let's talk about absolute assignments transferring ownership to someone else. The tax consequences depend entirely on who you're giving it to.
The rules are designed to prevent tax avoidance between family members. For non-arm's length transfers, so to a sibling, a cousin, a corporation you control, the proceeds are deemed to be the policy's cash surrender value minus any loans. It doesn't matter what price you actually agreed on.
So if Robert assigns his policy, it's got an ACB of $34,000, CSV of $61,000 to his brother, Jim. The government makes sure Robert realizes that gain.
Exactly. Even if Jim only paid him $1 for it, Robert immediately realizes a $27,000 policy gain and he pays the tax on it.
But the benefit is that Jim gets the policy with a stepped-up ACB of $61,000.
Right. It reduces his future tax liability. The tax is paid now by the original owner and the policy starts fresh.
The spousal rollover, though, that's the government's gift. It's the automatic tax-free transfer.
It's designed for smooth marital planning. When Noah assigns his policy CSV $85,000, ACB $32,000 to his wife Eve, Noah's proceeds are deemed to be his ACB of $32,000.
Resulting in a $0 policy gain.
A $0 gain for Noah. Eve gets the policy with that same $32,000 ACB. It's a clean deferral of the tax liability.
But the source material details a fascinating strategy.
Yeah.
You can actually opt out of that spousal rollover. Why on earth would anyone voluntarily take a massive policy gain?
You do it strategically if the person giving the policy, say, Noah has substantial income losses they can use to absorb that gain. And we're not talking about capital losses, but things like rental losses or non-capital business losses.
Walk us through that benefit. How does that work?
Okay, let's say Noah has a $70,000 rental loss he needs to use up. If he opts out, he realizes a $53,000 policy gain.
That's the $85K CSV minus the $32K ACB.
Right. His $70,000 rental loss completely swallows that $53,000 gain, so he pays zero tax. But the massive advantage is that Eve, the recipient, receives the policy with the full stepped-up ACB of $85,000.
So she has significantly deferred, and maybe even reduced, her future tax liability.
It's a powerful strategy. It takes careful planning, but it's powerful.
That's brilliant. But if the rollover is used, you also have to watch out for the risk of income attribution.
This is a huge trap. If the spousal rollover is used, and the recipient's spouse, Eve, later surrenders the policy while the transferor, Noah, is still alive.
Oh, no.
The resulting policy gain is attributed back and taxed to the original transfer. So if Eve surrenders it for a $62,000 gain years later, Noah has to report that income, even if they're divorced, even if Eve spent all the cash.
That attribution risk brings us to the final strategic play, the intergenerational transfer to a child or grandchild, often for education funding.
There's a special tax-free rollover available for this, but two rules have to be met. The transfer has to be a gift. No money can change hands, and the life insured must be the child or the grandchild. You can't transfer a policy to your child if you are the person insured.
The strategy here is all about using the recipient's low tax bracket to pull out policy growth tax efficiently.
It's a superb example of tax arbitrage. Let's look at Dorothy. She's a grandmother in a high tax bracket. She max funds a universal life policy on her granddaughter Jackie's life. When Jackie turns 18, the policy has a CSV of $54,000 and an ACB of $18,000. Dorothy gifts the policy to Jackie.
And since it qualifies for the rollover, Dorothy reports a $0 gain. Jackie gets the policy with that low inherited ACB of $18,000.
Now for the payoff. Jackie is a university student with very little income. She withdraws $15,000 for her tuition. Because of the prorated ACB, that withdrawal results in a $10,000 policy gain. But because she has minimal other income, that $10,000 gain is fully sheltered by her basic personal exemption.
So she pays zero tax.
Zero tax. But if Dorothy, the high-income grandma, had kept the policy and made that withdrawal herself, she would have been hit with a tax bill of maybe $4,000 or $5,000 on that gain. That skip-a-generation strategy is incredibly powerful.
Is there a catch?
Just one. It only works if the recipient is 18 or older. If the child is a minor, under 18, the income attribution rules apply, and the gain gets taxed back to the original policyholder, Dorothy. It defeats the whole purpose. So to synthesize all this, permanent life insurance is a fragile but highly effective tax shelter. The government lets you have tax-deferred growth only if you maintain a primary focus on the insurance protection side of things, and that's rigorously enforced by the MTR and the anti-dumping rules. If you approach this like a pure investment, the penalties are swift and they are permanent.
Understanding your adjusted cost basis, your ACB, that's the #1 takeaway.
Well,
It is the key to every single transaction involving your policy, whether it's a loan, a partial withdrawal, or an assignment. Knowing the ACB's relationship to the policy's value determines whether you maximize your tax benefits or get a nasty surprise from the government. The entire system rewards planning and awareness. So here's a provocative thought for you to chew on. If you own a permanent life insurance policy, do you know the generation of your policy? Is it a G1, G2, or G3? And more importantly, how confident are you that your current contribution schedule won't accidentally trigger that 250% anti-dump-in rule years down the line? That single threshold could alter your policy's tax status forever, changing a decades-long financial plan in a single afternoon.